Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. Excited to be here with you today. We have a really fun show lined up for you. The first time I met our guest today, she yelled at me. Actually, that's exactly what happened. She yelled at me because I was like $1.5 million. It was like some odd amount of money short for raising capital for this deal. And she said, why didn't you just call me? And I'm like, well, I didn't know that's what you did. And so I got this like earful, and I'm like, yes, Mom, that sounds fantastic. Let's do it next time. And then come to find out her name is Kathy Fettke. And like she runs a Real Wealth Network. She has a very successful podcast, if not one, two podcasts that you should absolutely listen to. And is a wealth of information for investors from around the world. She's raised for deals. She's done real estate deals herself. She knows the game inside and out. She lives in California. She's a surfer. Like, what does she not do? I don't know. But if there's one trait that I absolutely love about our guest today, it's when she walks into a room, there is a specific request that she has, and it's very similar to my request, except it's the color of the M&Ms that we want in the color of M&M bowl with the M side face up. I can totally see our guest, Kathy, asking for, okay, if I'm going to do a keynote, ladies and gentlemen, I need to make sure that I have a blue bowl filled with blue M&Ms with the M side face up. So I cannot wait to interview my friend Kathy Fettke in just a few minutes. This show is brought to you by Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. Learn more at realpropertymgt.com. Again, that's realpropertymgt.com. You can also give them a call at 888-806-7088. Ladies and gentlemen, boys and girls, it is Kathy Fettke. Kathy, welcome to the show.
What an intro. So let me be real clear. I am, once a mother, always a mother. Can't help myself. I'm about to be a grandmother, so it could get worse.
Congratulations.
And you're completely wrong. It would never, you don't know me, Abhi, clearly never M&Ms, but I would absolutely require an organic smoothie with an organic acai bowl. Then with some...
There you go.
Yeah. And where is it? I don't see it. I've got this interview, and where's my smoothie?
Yeah, I mean, I'm sure it's somewhere, or it's like being made and on its way to you.
Okay.
All right. All good. But thanks so much for joining us. I want to pick your brain for just a few minutes, but give us a little intro on who you are and what you do.
I am the co-CEO of Real Wealth Network. We have almost... 48,000 members now, very close to our 2020 goal of 50,000. So things have been growing exponentially. We help investors, we try to simplify buy and hold real estate investing, passive income investing for our members who are busy Silicon Valley entrepreneurs or engineers or Hollywood directors, producers, who it all sounds very glamorous, but they work a lot, sometimes 80 hours a week. They would love to invest all the money they make, but they don't have time. So we simplify that process for them. We help people, and also people just starting out. A lot of members of Real Wealth Network live in high-priced markets like California, where they dream of owning real estate, and that dream is so out of reach. You would have to have $200,000 or $300,000 down payment at minimum, probably more like $400,000 or $500,000 down to get a property. So they just don't know. Don't laugh, but they literally don't know that there's life outside of California. And I show them that. I take them by the bus loads to other cities. I'll have a room full of Silicon Valley engineers and say, hey, has anyone here been to, say, Cleveland or Atlanta or Jacksonville, Florida? Nope.
Nope.
Birmingham.
Not at all.
No,
right. They're like,
nope.
Right. I'm sure they're like, wait, I thought California was a country. I didn't realize that we were attached to, everybody else.
Yeah, it feels like the earthquake separated us a long time ago. But
Yeah.
but they, if I say, what do you think is in Kansas City? And I mean, literally, they'll say, horses, cows,
Right.
hay.
The movie Twister.
So it's my passion to kind of show how diverse this country is and all the growth that's happening in cities that haven't made headline news. So there's still opportunity, because if you went to China and just dropped in and said, hey, if you were to invest in the US, where would you invest? It's probably not going to be Cleveland or
Right.
Detroit, because it's not a headline city, but it's an underdog really coming up. And so we have this opportunity to buy great deals in cities that are reinventing themselves. And to me, that's incredibly exciting, to invest in the US and to teach people about geography. We don't learn that in California.
I mean, I know there's a Northern California and a Southern California, and I just like the Southern California side. No, but to your point, if you go to China, they're like, well, we like Vancouver, Los Angeles, San Francisco, Boston, New York, and Orlando. And that's really all they care about.
Las Vegas, maybe. I mean, the Chinese investors in particular really love California and New York.
Yeah.
I think some cities in Texas, maybe Dallas, Seattle potentially, but and even that's changing, where there was big headline news just last month that Chinese buyers have really backed off, I think 30% or more this past year, because obviously there's tension between the U.S. and China. But even more importantly, even before Trump, there was a plan that the Chinese government had made it very clear to keep investor money in the country, to invest at home. Yep. And when your Chinese government tells you what to do, I think you're supposed to do it. So that's kind of what we've seen as a
Right, that's kind of how a communist government works, the last time I checked. But you're 1,000% right. So there's been a lot of news over the last couple of weeks. We've seen the markets, and then rally, and then done this. The Fed, they're cutting interest rates. Help me make sense of this, right? I'm your average Joe real estate investor guy. I like doing flips every now and then. I like owning single family rentals. And I like getting my haircuts. Help me understand, what's going on in the market, and maybe what I should be reading into, so that I can take home a piece of knowledge that's actionable and say, hey, you know what? I'm making the right decisions.
Yeah, so I'll go very high level, because you asked that. So a lot of people most people know that real estate is a great vehicle for building wealth. It's just that what they don't maybe know is that there's a lot of ways to do it, right? You can invest in tax liens and notes. You can do multifamily or single family. You can do flips or buy and hold, commercial real estate, retail. Within commercial alone, there's so many different things to invest in. So, when we talk about real estate, it's just too broad of a term. It's like talking about the stock market. There's a whole lot of companies in the stock market. So just call it the stock market is incorrect as well. There's going to be stocks that do well and others that don't, depending on where the market is headed. So let's just start there, that there's just no one real estate. There's a whole bunch of different real estate that performs differently at different times in the cycle. So if you're going to be flipping property, that's going to be harder today, because prices have gone up and margins have gone down. Especially over the past year, when interest rates went up, the housing market, and again, I'm using that on a broad term, but real estate really came to a halt. Sales for single family homes kind of topped out, because a lot of cities had reached their affordability limit. So if you tried to buy a house, fix it up, and sell it, it was a lot harder to do last year. Now, if you did that 5 or 10 years ago, you had a lot of momentum on your side. Yeah. Even if you everything out, if you bought wrong, paid too much, it took too long to renovate, it cost more than you thought, you'd still probably make money because the market went up. Now,
I'm so jealous of those days, right? You could screw up and still make money. You'd be A-okay. I'm like, yeah, that sounds like a market that I wish was back.
Right. And so a lot of people might be watching HGTV shows that were filmed years ago, thinking that that's how it is today, and it's not. So it's a lot harder. Doesn't mean you can't do it, but it does mean you can't mess up.
That's
You've
right.
got to meet your timelines. You've got to know your budgets. You've got to know the right neighborhoods and the comps, like what is selling and how quickly is it selling. Now, today's numbers came out for existing home sales, and sales were up. So that's good. And that we're going to probably see a little more of that because the Federal Reserve just lowered interest rates. And this is the important thing from, again, a high level, that we just had a shifting of the tides. So to use the surf terminology, like when you introduced me, Rich and I love to surf. We have a little surf spot. I'm not going to tell you where. It's a secret. A surfer never tells their secrets because we don't need any more competition for the waves. But our little surf spot, we know that when the tides are changing, there's like your entire strategy changes because the wave is different. And as the tide is going out, oh my gosh, it's way more dangerous because there's exposure to all the coral and the rocks below. Whereas if the tide's coming in, I can fall. I can make more mistakes, right? Because there's cushion. Yeah. So we're in that right now. There's a changing of the tides. Last year and for the last several years, the Federal Reserve was tightening, which is what I would say is kind of like the tides going out. Like it was getting a little more dangerous to do business because when the Fed raises rates, the intention is to slow down the economy. And it totally worked. It totally worked. It was their intention and it worked. And the intention was to not create more bubbles. Yeah. Well, we have a president who doesn't really want a slowing economy, right? Even if that might be good for us because, we need to level out. Yeah. Housing, the headlines until now were like, oh, housing too expensive. And then when the Fed slows it down, people freak out. It's like, what are you going to think about? The price is going up or price is going down? Which one? Like, it's pretty funny. So the president, again, doesn't want a slowing economy while he's campaigning. So for the first time that I've ever seen in history, there has been a battle between the president and the Federal Reserve. And you know what? Our president tends to win. So he won this case. And the way that maybe I'm just guessing one of the ways that he's been able to do that is with tariffs. By threatening more tariffs, it really affects the stock market. And when the stock market rumbles, well, then the Fed lowers rates, and that tends to generate more business because money's cheaper, and the president gets what he wants. So there is speculation that maybe this last threat to do an additional 10% of tariffs was really just so that the Fed would be scared into lowering rates as opposed to raising them, which is, again, stimulating the economy instead of the opposite. So it's good for the president, really.
Right. So as an investor, how do I take advantage of, or how can I be prepared to take advantage of the low interest rate environment that we're headed into, right? Like I think the Fed said they're going to cut interest rates maybe 1 or 2 more times toward the end of the year, early next year, potentially. That's a very interesting thing to note and to take special attention to.
Well, the way I see it is it's going to stimulate the economy. That's the intention. So it will. And we will probably, it could be a buying opportunity in the stock market for a period of time. And we will probably see an increase in home sales as a result of it because rates are cheaper and more people can qualify and feel confident. More refis. The housing market in the U.S. is, let's just put it this way, the economy is very dependent on a healthy real estate market. And so this will stimulate the real estate market because there's so many jobs related to that. There's agents, there's title companies, there's construction workers. There's so much involved with a healthy housing market that it will probably see a booming economy for a while. And when I say a while, I mean for the rest of the year. Right. But the big problems haven't been fixed. So it's really a temporary fix. And it's a temporary fix. There are problems looming. There's big problems looming. So as an investor, we are really cautioning people to make super wise decisions. Don't be doing a flip that is going to take you a long time. Do quick flips, in and out. Don't take on any debt that will balloon in a year or 2 or 5, because we don't really know where the interest rates are going to be. We don't even know if there will be money available. So stay away from short-term loans, in my opinion. Get into fixed rate, long-term debt at low LTVs, to just kind of prepare, like, this is going to be a nice boom, but it's temporary, and it's a great opportunity to prepare yourself for what could be uncertain times.
We need to have you back to talk about some of these uncertain times, because there's, again, like you said, with the high tide and low tide surfing strategy, there's very distinctly a strategy on what investors should do in a market that's doing really well. And I'm using the word market very loosely here, but in a market that's doing very well versus a market that's in the dump. So maybe we can outline that for our viewers and listeners some other time. But this has been really educational. And for a lot of investors that don't really understand that, hey, news is important. What's happening in the world around us affects everything. So make sure that you start to pay some very keen attention to what Kathy is saying with not only some of these news stories and headlines, but why interest rates are important, and why this China stuff is important, and what President Trump is doing, and what investors are doing, and what new investors are doing. Get out of your market and see what makes sense in Detroit, Cleveland, right? Kansas City. You might want to take a look at North Carolina, South Carolina. I mean, there's so many opportunities as well in Alabama. So if you go to, Kathy, your website is
realwealthnetwork.com. And we do feature different real estate markets that are really up and coming. And just a quick, I know we got to wrap up, but in 2005, we helped a lot of investors avoid any pain from the recession at all, because they repositioned at the right time. They sold their underperforming, high-priced bubble properties, and they exchanged them tax-deferred into really low-cost markets with high cash flow that where the job growth is. And so basically people sold their California properties, those who listened to us, and we helped them buy in Dallas, Texas, which was at the beginning of its boom. And those people who listened, they didn't even feel the Great Recession. That's where we're at right now. We have this amazing opportunity, because there's a little bit more of a boom to go, to sell your underperforming assets, your overpriced underperforming assets, and exchange them into high cash flow, low priced properties in really strong growth, job growth market. You're
giving away all the secrets, right? We're going to have to censor this. We're going to be like, beep, 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 beep. I love that strategy. It's something that I'm personally also deploying, going into some of these secondary and tertiary markets, buying property between $75,000 and $120,000, $130,000, seeing some good cash flow, long-term tenants, and putting long-term debt in place. I mean, it is a total winner, and I love it. So, Kathy, thanks so much. I certainly appreciate it. You've got a podcast. You can follow Kathy and Rich Fettke at realwealthnetwork.com. Again, that's realwealthnetwork.com. You can do a quick search on either iTunes or your Google Play or SoundCloud or anywhere, Spotify. Just type in Kathy Fettke and her name will come up, and you can click on whichever podcast you'd like to listen to. Kathy, I listen to you a lot. Thank you so much again. I certainly appreciate your time.
Thanks for having me.
You got it. Think Realty Nation. We'll be right back. Think Realty Nation. So I've learned a lot from Kathy, and I'm sure you have as well. We take a look at investing strategies that matter right now, that's sensitive to what's going on in the news, in the world, and your local market. Pay attention, buy smart, and most importantly, just please, just don't be dumb with your investments. And dumb is a very technical word, okay? I like using that word a lot, especially when it's right. Oh, man, some people will learn and some people won't. And I really, really want to reach everybody so that we can all make money together. That's the point, together. Let's a nice big hug. All right. This next segment is brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. So, interesting article on Think Realty and also AdamData.com about the So Adam Data Solutions was examining the grocery store impact on the U.S. housing market, and there's a really interesting infographic here. The average home value, if your home's like near a Trader Joe's, the average home value there is, holy cow, is this even right? There's no way. Okay, I'm looking at this data and I'm like super absolutely surprised. Okay, average home values near Trader Joe's is $608,305 compared to if your home is near a Whole Foods, $521,000, and if your home is near an Aldi, $222,000. Adam Data Solutions very recently released its 2019 grocery store battle analysis, which examined whether living near Trader Joe's, a Whole Foods, or an Aldi can affect your home value. And what it is showing, it's showing that it absolutely, I mean, I'm looking at this trend line and it's showing that it absolutely can. Homes near Trader Joe's realize an average home seller ROI, return on investment, of roughly 51%, compared to homes near a Whole Foods with an average home seller ROI 41% versus an Aldi at 34%. So this is very interesting. So what does this mean for investors? Does this mean that we should all rush to buy near a Whole Foods or an Aldi or a Trader Joe's? I think it would marginally increase your home sales price just because you're near convenience stores, you're near grocery stores, just like you would be near a major highway transportation system or near a bunch of amenities. But I don't think it's going to be, I mean, just in my, I mean, it'll help, but it's, my version is, it's probably, yeah, you'll get a little bit of a premium, but you know, I would be more concerned about the area, of course, schools and crime. But you know what? I'll give it to you. I'll give it to you, Adam Data Solutions. You've convinced me, looking at this data, that I'm probably going to sell my home for a little more. Today's sponsor is Real Property Management. And Real Property Management, if you don't know, is the largest residential property management franchise in North America, so get to know them. They manage tens of thousands of properties for individuals, investors, and institutions throughout the country. You can learn more about Real Property Management by visiting www.realpropertymgt.com. That's realpropertymgt.com. You can also give them a call at 888-806-7088. Once again, 888-806-7088. Think Realty Nation, it's been fun. I hope you learned a lot. I did. And until next time, happy investing.